London, winter of 1693. King William III is broke. His navy is months behind on wages. Sailors are deserting. Tax collectors are literally being chased through the streets, and the war with France is draining the treasury dry. England has tried everything. Forced loans, higher taxes, begging wealthy merchants for credit. Most of them said no. Then, a group of London financiers steps forward with a strange proposal. We'll lend you the money, but not the usual way. Not a loan you pay off, a loan you service. You pay us interest every year, funded by future taxes. In exchange, we'll create a new institution to manage this permanent arrangement. That institution becomes the Bank of England. Parliament says yes. And in solving an immediate crisis, England accidentally rewires how money and power will work for the next 3 centuries. They didn't just borrow money, they created a machine that could run on debt forever. And here's the part that matters. You are still living inside that machine today. Let's talk about why this matters now. Back in 1694, the Bank of England launched with a loan of just over £1.2 million. That was enough to change the game. Today, the United States is carrying around $38 trillion in federal debt. Annual interest payments are closing in on $1 trillion, more than many cabinet departments spend in an entire year. This isn't some dusty history lesson. This is the origin story of the system you feel every time. Prices outrun your paycheck. Congress fights over the debt ceiling. Your retirement account feels like it's sprinting just to stay in place. If you've ever wondered why the debt never gets paid down, why it only grows, the answer isn't corruption or stupidity, it's incentives. Once a system is built to run on rolling debt, shrinking it becomes the most painful path, so it almost never happens. To understand the pressure we're under today, you have to see how the original machine was built. So let's go back to the origin story. In the early 1600s, England had already burned through its credit and defaulted on previous loans. By 1694, the monarchy had almost no trust left in financial markets. The navy needed money, the government needed money, but nobody would lend to them. So, a Scottish financier named William Paterson pitches a radical idea. Create one central institution that pools capital from wealthy subscribers. Lend that money to the crown and guarantee perpetual interest payments funded by taxes. No maturity date, no plan to pay back the principal, just interest forever. People at the time were already uneasy. One pamphleteer wondered if England was creating a public debt that might become a weight upon future generations. But Parliament had their backs against the wall. So in July of 1694, the Bank of England receives its charter. £1.2 million are raised. The war gets funded, and wealthy lenders get a guaranteed return, backed by the government. Here's the real innovation. Instead of paying off debt, England learns it can just roll it forever. As long as taxes come in, as long as the economy grows, as long as interest gets paid, the machine keeps running, and lenders keep lending. That's how the modern world begins. Now, let's look at how this pattern spreads. Britain uses this funded debt playbook to finance the War of Spanish Succession, the 7 Years' War, the Napoleonic Wars, and the expansion of its empire. Other nations copy it. Even France, which resisted central banking for decades, eventually builds its own system for managing national credit. By the late 1700s, thinkers like David Hume and Adam Smith were already warning, paraphrasing here, that once a country normalizes permanent public debt, it risks ruin if the burden outgrows its ability to pay. But the machine works. Funded debt lets governments fight wars, build infrastructure, handle crises, and avoid immediate taxpayer revolts. Then, in 1913, the United States creates the Federal Reserve, a hybrid central bank with a public mandate but private ownership structures, designed to stabilize credit markets. It's a direct descendant of the 1694 model. World War I and World War II push government borrowing to levels nobody thought possible. But by then, the architecture is fully in place. Governments issue bonds. Central banks manage liquidity. The debt rolls forward. And in 1971, President Nixon closes the gold window. Currencies go fully fiat, no metal backing, only the credibility of the issuing government. At this point, nearly every major economy on Earth is using some variation of the same 1694 machine, just scaled up into the trillions. Now let's bring this into 2025. The modern stress point. Federal debt is roughly $38 trillion. Interest payments are approaching $1 trillion per year. Why not pay it down? Because doing so would require major tax hikes, deep spending cuts, or giant sustained surpluses. none of which are politically survivable. And here's the economic problem. Paying down trillions means pulling trillions out of the economy. That risks recession. Recession shrinks tax revenue. Shrinking revenue makes the debt problem worse. So the machine defaults to its original setting. Roll it, refinance it, keep interest manageable, let inflation and growth shoulder the long-term load. But the machine is getting harder to operate. If interest rates rise, servicing the debt becomes explosive. If growth slows, deficits widen. If the population ages, entitlement costs rise. In 1694, this was a clever hack to fund a war. In 2025, it is the operating system of a $25 trillion economy. And you feel it every day. Higher prices, more fragile job markets, retirement projections quietly slipping. The promises are still rolling. But for how long? Okay, let's talk about how this machine usually breaks. Not predictions, patterns, because when a system is built on rolling, perpetual debt, history gives us only a few endings. First ending, the slow bleed. Nothing dramatic happens. Interest eats more of the budget every year. Taxes drift upward. Services slowly get worse. Wages stagnate. Growth drags. Households feel squeezed. Not in a crisis way, but in a why does everything feel harder than it used to way. Most debt-heavy empires don't blow up. They just fade. Second ending, something snaps. A shock hits the wrong part of the system, a sovereign default, a corporate credit wave, a derivatives unwind, or simply a sudden loss of confidence in government bonds. Modern finance is a web of promises. When a big promise breaks, panic spreads. Credit freezes. Asset prices fall. Institutions scramble. We've seen versions of this. 2008, the Eurozone crisis, the gilt meltdown in the UK in 2022. Each rescue stabilizes the moment, but increases the long-term pressure underneath. Third ending, the rules change. This is the oldest play. When growth and taxes can't close the gap, governments change the contract. Sometimes it's a currency reform. Sometimes it's steady inflation that erodes debts quietly. Sometimes it's revaluing assets on the state balance sheet. We've seen this too. Britain leaving the gold standard in 1931. The US closing the gold window in 1971. Sovereign restructurings across Latin America and Eastern Europe. When the old rules make debts unpayable, the rules change, and the people holding the old promises take the hit. So what does someone like you actually do? You can't vote away $38 trillion of federal debt. You can't control global confidence in US bonds, but you can decide how exposed your personal finances are to a system built in 1694. These aren't instructions. They're frameworks for thinking clearly inside this machine. Principle 1. Know which promises you're funding. Look at your retirement accounts and savings. If you're in bond-heavy funds, you're relying heavily on the smooth functioning of the debt machine. It might keep running, but if it doesn't, those safe assets lose purchasing power quietly. Know what you own. Know the risks attached to it. Principle 2. Reduce your dependence on fragile IOUs. High-interest consumer debt, credit cards, variable rate loans, puts you at risk in every version of this story. In a slow bleed, rising prices eat your margin. In a snap, credit lines can disappear overnight. In a rule rewrite, your savings can lose real value faster than your debt shrinks. The goal is not perfection. The goal is resilience. Principle 3. Hold at least some non-IOU assets. Non-IOU assets are things whose value doesn't depend entirely on a government promise. Examples include productive businesses, real estate with sensible leverage, commodities, a modest allocation to gold, and for some people, Bitcoin, if you understand custody and volatility. The goal isn't heroics, it's diversification by risk type. Historically, when rules changed, the people who survived weren't the ones with perfect portfolios. They were the ones who weren't all in on paper promises. Quick disclaimer, this is education, not personal financial advice. Your situation is unique. Talk to a qualified professional before making major changes. But go into that conversation informed. Understand the system you're navigating. Understand how it behaves under stress. Understand which risks are obvious and which are buried in the structure itself. The machine built in 1694 is still running, and you are still inside it. The Bank of England didn't just fund a war. It created a way of running countries on permanent promises. Promises we're still rolling today. You can't stop the machine, but you can decide how vulnerable you are to it. This is Money Margins. We make sense of the chaos so you can protect your future. Thanks for watching.